Very soon, it's going to happen. We're going to go into this slide by slide. Now it's the opposite. Now the price is going up and up and up, and the amount of silver in SLV is going down and down and down.
Good day, investors, and welcome to Economy Express, your trusted source for financial insights. Today, we bring you breaking news from the gold and silver markets, developments that could reshape the landscape of precious metals investing. Something big is brewing, and if you are holding or considering an investment in gold and silver, you'll want to hear this now. Could we be on the brink of a historic supply squeeze?
Something crazy is going on in SLV, in the gold and silver markets. There's a lot of bullion that continues to flow from London or its proxies into New York. The flow has not stopped, and it looks like there is some kind of supply shortage, especially in the silver bullion market. We can see that from the borrowing rates for SLV particularly. GLD is also spiking, which means that there are a lot of shares being borrowed, which in any normal time would mean that people are shorting these funds, but in these times when silver and gold bullion are in serious demand, they're probably borrowing these funds in order to redeem baskets to fulfill the demand for bullion, and now they are short these ETFs and they cannot cover yet. We're going to go into this slide by slide. But anyway, let's get to these important slides. These charts are from Bob Coleman. Follow him on Twitter. He knows a lot more about the intricacies of the COMEX than I do. I can give a good overview, but he knows the mechanics of it. So the GLD borrowing fee spike, hat tip, Bob Coleman. The borrowing fee on GLD, that's the gold ETF that has the most gold in it of any ETF. So we'll use it as a proxy for the entire ETF market. The borrowing fee has gone up to 4.7%. You can see here from 2.4% back 2 days ago or 3 days ago, depending on when you're watching this. February 5th, it was 2.4%. Now it's 4.7%. This is the daily chart of the GLD borrowing fee. You can see here there was a huge spike. The available amount of shares of GLD for borrowing was 1.3 million 2 days ago, and now it is 1.1 billion. So there's still 1.1 million, excuse me. So there's still a fair amount of shares, and it hasn't really shrunk that much. So do I think that there is a squeeze in GLD? Not quite yet. We'll go to the next slide in a second. But the point here is, why would people be borrowing GLD? They'd be borrowing it so that they can redeem those shares for bullion. How GLD works is you redeem a certain amount of shares for bullion in a basket, and then you can take that bullion and do what you want with it. But if they don't own those shares and they redeem them, and those shares no longer exist, and they have to buy them back from somebody else or put the gold back, so they are short gold now in order to fulfill some kind of a delivery, something. Nobody knows exactly what. But we go to the next slide here. We see what is going on. I don't think there's quite a squeeze in gold just yet, but wait until we get to silver. This is Ronan Manley. Follow him on Twitter. Bullion banks are borrowing GLD shares and converting the units to physical and gaining control over that metal, i.e. rating the SPDR Gold Trust. So I looked at the GCRU, the Gold Charts Are Us charts here of the GLD ETF, and you can see here on the top, gold is going up. It's now at $263 a share.
Could this be the trigger that sets off a chain reaction in the global financial system? Let's break it all down. Something massive is unfolding in the silver market. Renowned financial analyst Rafi Farber has sounded the alarm. The supply of silver is draining at an unprecedented rate, while prices are climbing higher. Typically, when prices rise, we expect an increase in ETF holdings as investors flock to these funds. But this time, the exact opposite is happening. Over the past 3 weeks, the holdings in SLV, the largest silver ETF, have dropped by 1,000 tons, even as silver prices continue to rise.
And that's an all-time high. I think it was the all-time high was 265, so we're right there. And the total metal in the trust, it has not gone much. It hasn't gone down. It hasn't gone up. It's stayed pretty steady since January, slightly down from whatever this is. I can't really see. It was at 870 tons to now 864. So about 10 tons. It's been down a little bit, but this doesn't look like a squeeze just yet. The thing is that and I'll show you this in the following charts, that the holdings in the GLD are not going up. So it could be that the demand for GLD is being canceled out by the demand for the gold in the GLD in order to fulfill delivery requests. Here you can see the movement of the price in GLD and the amount of gold in the fund. It doesn't look like it's being slammed down so much. But if we move to SLV, we can see there is a major difference this time. I show you here the 2020 delivery rush. Remember, there were huge amounts of deliveries in 2020, especially for silver and gold. There were all-time records back then. You could see here the black line and the blue line were going in tandem. So the blue line is the price of SLV shares. The price of silver was going up, and you can see the black line, the amount of silver in the ETF was going up and up and up and up. So the demand was to put silver in that ETF at that time. That's what the deliveries were going for. A lot of them, at least not all of them, but a lot of them were. Now it's the opposite. Now the price is going up and up and up, and the amount of silver in SLV is going down and down and down, almost in a mirror image. So as the price goes up, people are shorting this ETF. We'll see those numbers in a second, and they're taking this silver and they're using it for deliveries. Exactly what to who, we don't know. So if we zoom in on this, we can see that the amount of holdings have gone down about 1,100 tons in 3 weeks as the price has meandered, and it's nearing $30 for SLV right now. So yeah, this does look like a run on SLV. And Ronan Manley also notes, and Bob Coleman too, that the borrowing rate on SLV has skyrocketed a lot higher than GLD. So I think the squeeze right now is in SLV and in silver, less so in gold, but gold could catch up, and it might be doing that right now. What happens if these funds are being rated? If SLV and GLD are actually being rated, then here are the logical points. If they're borrowing shares, if big financial centers are borrowing shares of GLD to SLV to redeem baskets and get that gold and silver out to satisfy physical demand, then they will have to buy those shares back at some point to cover. Third point, if gold and silver continue to rise when they are short that gold because they've already sold it to somebody and they're short the shares, and they are short shares because they needed them to redeem baskets, they will get squeezed. This could very quickly trigger a dollar collapse. Will it necessarily? No, but this is one of the mechanisms that could cause a serious bash or a serious drop in the dollar and all of its purchasing power. Eventually, it's going to happen. Whether these ETFs are going to be the trigger of it, I don't know, but they are one potential. Basically, they trade paper claims on gold or the electronic equivalent. Now, the key here is in the bold. These claims are now trading at a discount to reflect the fact that they can't be converted at will into physical due to a lack of availability of sufficient local London physical gold. And so the claims on gold are starting to trade at a discount to physical gold. As the demand for physical gold rises, the demand for electronic gold falls, and you have a spread here. And so that spread could be encouraging people to sell short SLV, where you can get silver cheaper and deliver it for a premium because people want physical now. There's starting to be a loss of faith in the system. It's manifesting as a premium for physical over electronic or paper. Now, in the gold market, we can see here, we have open interest versus the price. The price keeps going up and up and up, and open interest keeps going down from a peak of 600,000 to now about 535,000. These numbers are 1 day out of date. Why is this happening? It's not exactly a short squeeze. What is happening is that open interest is closing because of deliveries being made. Once the delivery is made, the contract closes, open interest falls. And because these deliveries are not and because open interest is not falling through the sale of a position, then the price doesn't get affected by the open interest falling. It just keeps rising and rising. Open interest is resetting itself downward, which will give us the fuel for another leg up at some point. If we're still already in it, we might already be in it now. I don't know. Now, for the delivery picture, here's where we are. We're on pace for 60,847 warrant deliveries from London to New York primarily. We can see here the total is 52,577, and the remaining open interest is 10,382 contracts for the February contract still open. If we subtract 2,112 from that, because this is 1 day behind and this is current, then we have a total of 60,847 warrant deliveries. That would be an all-time record. The all-time record is 55,102, if I am not mistaken. So here we can see the deliveries, and everything before 2020 is much, much lower than these numbers, so there's no reason to stretch out the graph that far. This is the all-time record over here in June 2020. We can see here that we're already at 52,577, and we're going to breach the all-time high in the next 2 or 3 days as these contracts continue to be delivered. A lot of that gold is headed into the COMEX, which is nearing the all-time highs for physical supplies that we saw in 2020. We're not quite there yet. We're about 6 million or so ounces below the all-time high. And now if we go back again and look at the difference between 2020 and now, the 2020 delivery rush, that was over here from about April, May to about July, August 2020. Where was that physical going? It was going into the ETF. You can see the black line here for the total GLD amount of gold in the fund. It went from about 900 tons to 1,270 tons, something like that, in the space of that price increase. Now the price increase is not affecting the ETF because the gold is being redeemed in order to satisfy more physical demand. So basically you could say it like this. In 2020, the demand for gold was in the paper market. Now it is in the physical because the paper market is not stuffing any more gold into its funds. The demand is going elsewhere for big actors that want the big bars and they don't want shares of GLD. You can see the same thing in silver also between 2020 and now. The ETF is going down. Back then it was going up in terms of the holdings. And I'm not talking about the rest, I'm talking about the holdings. The holdings were going up. Now the holdings are going down as the price goes up. So basically what I'm saying is that the demand, these delivery demands, are not going into the GLD or SLV ETFs. They're not going into the paper market. This reflects what Ronan Manley has been saying, that the demand premium is in the physical and the rest are trading at a discount because not all of the paper claims can be fulfilled with physical bullion anymore. Is this going to calm down? Is it going to cause a huge silver squeeze or gold squeeze? I don't know, but one day, very soon, it's going to happen.
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
Suggests that major financial players are redeeming ETF shares to secure physical silver, signaling a deepening supply crunch. And there's more. Borrowing rates for SLV have skyrocketed, far surpassing those of gold ETFs. This is a classic warning sign that demand for physical silver is outpacing available supply, leading to a potential short squeeze in the making. If this trend accelerates, we could see silver prices surge well beyond historical highs, putting short sellers in a precarious position. Could this be the silver squeeze that retail investors have long anticipated? What about gold? Major players are draining the GLD ETF. While silver takes center stage, the gold market is also experiencing seismic shifts. The borrowing fee for GLD, the largest gold-backed ETF, has surged from 2.4% to 4.7% in just days. This spike is a red flag, indicating that large financial institutions are aggressively borrowing GLD shares, converting them into physical bullion. Why is this important? Because historically, when demand for physical gold rises, it signals a flight to safety, a move we often see before major economic disruptions. Investors are beginning to question the reliability of paper gold claims, opting instead for tangible, deliverable metal. Even more concerning, the total gold holdings in GLD have remained flat, despite the surge in gold prices. This suggests that ETF demand is being offset by a relentless withdrawal of physical gold, possibly to fulfill delivery requests or as a hedge against financial instability. And here's where it gets even more interesting. Historically, when gold markets behave this way, a liquidity crisis in the dollar is never far behind. The bigger picture, is a financial reckoning on the horizon? Let's take a step back and assess the macro implications of these unfolding events. ETF holdings are being redeemed for physical metals. This means investors, particularly institutional ones, no longer trust paper-backed claims on gold and silver. They want the real thing. If ETFs are being emptied, what happens next? At some point, these institutions will need to buy back their shares to cover their positions, creating a self-reinforcing cycle of demand and price appreciation. A possible short squeeze in silver. If institutional players continue to borrow, redeem, and deplete supply, a severe shortage could trigger a silver price explosion, forcing short sellers to scramble for metal at any price. The US dollar faces new pressure. As demand for physical assets rises, confidence in fiat currencies, especially the US dollar, could wane, setting the stage for a major currency devaluation. So, what does this mean for investors? For those already holding gold and silver, these market moves validate your long-term strategy. If supply constraints persist, we could see substantial gains in the coming months. For those still on the sidelines, the message is clear. The window to secure physical metal at reasonable prices may be closing quickly. Final thoughts. The time to pay attention is now. To sum it all up, Silver ETF holdings are collapsing while prices rise, a classic signal of an imminent supply squeeze. Gold borrowing rates have surged, indicating major players are converting ETF shares into bullion. If demand for physical gold and silver continues to surge, we could witness an explosive price movement in the coming months. This could be the catalyst that finally shakes confidence in paper markets and triggers a broader financial reckoning. Are we on the verge of a historic turning point in the global financial system? Only time will tell, but one thing is certain: smart money is already making moves. The question is, are you paying attention? That's it for today's Economy Express Bulletin. If you found this analysis valuable, be sure to like, share, and subscribe to stay ahead of market-moving events. Drop a comment below. Do you think we are witnessing the beginning of the Great Silver Squeeze? Until next time, stay sharp, stay prepared, and keep stacking. This is Economy Express, your go-to source for financial insight and economic analysis.